All right, it is now Global Bank on it. The European markets have just closed, and for the most part, they were down and down quite a bit, 3% or more losses across the board. Whether you're talking Britain, what's going on in France or Germany, all the markets feeling the same banking fears that we are here. Is that justified? Kevin Hassett, the former Council Economic Advisors Chairman under President Trump, author of a runaway bestseller, The Drift. Well, no drift here. I mean, it's a real wave of selling globally, as you know, Kevin. A lot of people are saying more shoes drop. But I don't know if once you have one shoe drop, you only have one to go. But I guess the fear is that this ain't over. What do you think?
You know, I think that if we look at the banks that are in trouble, that they have pretty idiosyncratic problems. And the, policymakers have stepped in with pretty strong policies, very generous policies. And so my guess is that the contagion effect is going to abate. Frankly, if I were on the Fed, I would still raise rates at the next meeting and look at inflation as the number one problem. Really, the fact is that if you go back and look at the 70s when inflation really got out of control, what happened was that they would start to tighten and then things would get a little rough and then they'd chicken out and they'd loosen. And, that's the mistake that brought us into double-digit inflation. And frankly, the bailout right now, you could think of it as a kind of quantitative easing by the Fed here in the U.S. And so they're pushing inflation up. And so for me, yeah, I think that if you look at the idiosyncratic problems of the banks that have had trouble, they don't really spread to the entire system. And so I really don't think that we're looking at the kind of global collapse that we saw in 08, nothing close to it.
I hope you're right about that. The one thing I do remember about the meltdown, and we were covering it very closely, and you were living it very closely, is that, it got out of hand. Stocks started sinking fast, and then that was the very currency for a lot of these financial firms. Their stock collapsed. They really were losing money, both among investors and even among those who did not want to stay with those institutions. Do you see anything like that? That, in other words, let's say this is localized to these banks that had these unique issues. But now, and you've heard the reports, Kevin, of people running to big banks like Bank of America that's taken in $15 billion in deposits over the last week. It's clear why. People are nervous being in a smaller or less big bank. And I'm wondering whether that has a spillover effect and more go out precisely because of that.
It could for sure have a spillover effect. But one thing I'd like to say, I know that a lot of your viewers are worried about their own money all around the country. And the fact is that the FDIC insurance to $250 is pretty easy to spread over a heck of a lot of money, because you could go to like the 3 or 4 community banks in your hometown, or you could even go to like an online place like Vanguard, although I'm not doing an ad for them, and then buy CDs at a whole bunch of different banks at $250 and get the FDIC insurance. And so I don't think you have to run to the biggest banks in order to protect yourself. I do think that there's a concern that the sort of bailout for all depositors that we just saw is something that, frankly, the federal government can't finance forever. And so I know people right now are hunkering down and taking risk off, but I think that there's some prudent ways to do that don't lead to massive bank consolidation.
The administration, President Biden himself, had said that taxpayers aren't on the hook for these more generous FDIC paybacks for depositors, limitless, way beyond $250,000 for an individual or $500,000 for a couple. But I'm not the sharpest tool in the shed, Kevin, but that can't be. It's got to be reflected in higher bank fees that invariably, since banks pay for that, get transferred to us, right?
Yeah, that's right. And another way to think about it is, right, like if the Fed, so right now, suppose that you have a treasury that's really underwater because you bought it a few years ago when rates were really low and now rates are a lot higher. Right. Well, you can give it to the Fed and they'll give you money at par right now. And so, like, how much would you pay for the ability to take an underwater treasury and actually get, like, the face value of it? How much would you pay? That's, like, real money, right? And since the Fed is doing that, then the Fed is, spending real money that in the end is something that taxpayers are going to have to cover. So, yeah, I think that the bailout is definitely in the end going to be taxpayer money. But sometimes when there's a panic, right, the panic is totally irrational. And if you just get the panic to stop, then the assets are worth a lot more. And so if you go back and look at some of the other bailouts, which I generally opposed, you know me, for decades, the amount of money that the government ended up losing on the bailouts tended to be a lot smaller than the critics thought, because once you stop the panic, then the value of the asset goes up and it's not so bad.
Yeah, sometimes there were money made on TARP, for example. We'll see.
Yeah, that's right.
Goes.
Yeah.
Kevin, always enjoyed chatting. Thank you very, very much. Kevin Hassett on
Thanks,
all
Neil.
of those fast-moving developments.